Hey everybody, Courtney Smith here with our July 11th edition of Wall Street Winners. Unbelievable, times fly when you have a good time. So here we go, let's get going. All right, I called for the S&P to rally a few weeks ago, and it's really taking its time. But the fact that it's taking time says something about the quality of the market. So we said that there was a seasonal bullishness that was going to come up and that it would cause the stock market to rally until about the end of August. And I'll show you that chart in just a minute. But you can see that so far this rally has been very, very weak. Now, it is, at least there is a rally, okay? Now, notice that here on the S&P, we haven't broken above the highs we made 2 weeks ago. That hasn't happened yet. Let's take a look at the Dow. Hasn't broken above the highs, but selling pressure is coming down, buying pressure is coming up, so that's bullish. But the NASDAQ has barely broken above its previous highs, and the purple predictor is bullish. The on-balance volume is bullish. Now, let's go back over here. We're still neutral on the seasonality here. Now, there's the rally. The rally was supposed to start really at the end of June. Then we're supposed to have a little dip and then another rally. Well, if we go back, and I'm going to go back, I want to take a look now at let's go back. Let's take a look at the NASDAQ. So we were supposed to start at the end of June. Well, okay, we have. The rally has started. Now, first we had a little dip, now we had a rally. So it is happening, all right? But when you have a very weak bull market, when you're supposed to have a good bull market, that tells us that something is offsetting the bullish seasonality. In other words, the total situation is more bearish than normal. So yes, we can get a rally, but it's going to be a weak rally. But that also tells us then that the drop, which is going to start sometime in August, is going to be bigger than normal. Okay? You always, whenever you do seasonality, you're looking at timing, but you're also looking at strength of the move. And the strength of the move it's there, but it's weaker than normal. So as a result, we're going to look for the bear move to be weaker than normal. Okay? So yes, still looking for this rally into the beginning of August. Maybe, I mean, look at this. It's really quite flat until the third week in August, so we could see it even rally into the third week of August, but we'll be on notice of trying to flip from being bullish to bearish sometime in the first 3 weeks of August, all right? And then we're going to want to hammer the market hard as we go into the biggest bear move of the year. Asset allocation, we are getting money out of the bond market. When this line goes up, it means that people are taking money out of bonds and they're putting it into stocks. And notice that we didn't break to a new low, so right now we have a neutral market in asset allocation. The risk indicator, though, broke to new lows. So they're moving money out of bonds, but they're keeping it in really boring stocks. So consumer staples, utilities, things like that. Now, my feeling is that this rally should be stronger in all the stocks that got hammered in the first half of the year. In other words, technology stocks, Bitcoin, Zoom, anything having to do with COVID. It's now going to start to rally again because a lot of those stocks are down 80%. So if they're down 80%, 70%, 60%, I think they're going to lead the rally up. Having said that, and I showed you the NASDAQ chart had broken above its previous highs, whereas the Dow and the S&P have not. So that proves my case. But when I look at this chart, it shows, well, yes, we're going to take more risk, but it's going to be teeny tiny more risk. So that argues against my thesis. But we'll see. It's early. We'll see. Global shares. Look at that. We make a new low on this. I mean, really, being short global shares is much better than being short U.S. shares. Yield curve. Oh, my God. Look at that thing. Right off the edge of the table. Hammerama. And there we go. If you look closely down here in the lower right-hand corner, you can see that the hammerama got us down below 1.0. In other words, we got to a negative yield curve. Now, over in the lower left-hand side, doesn't show that, but this is a chart of the 3-month Treasury bill minus the 10-year Treasury, and we got to a negative yield curve. Remember, that curve has a perfect track record of predicting a recession, typically in a year, but it could be as short as 8 months. So once again, we're on track to first or second quarter of next year being when the recession officially hits. But the stock market predicts it. So that's why we have the big bear market now, because the stock market is a leading indicator of the recession. And in fact, when we hit the recession by second quarter of next year, you will be buying stocks heavily because the economy will be in tatters, earnings will be sharply negative, and the Fed will flinch and ease monetary policy. You heard it here first. That's right. I'm reading Jerome Powell's diary from next year. That's how I get this information. Okay, bonds. Actually, these are 20 years. We're going to start to crack down again, I think, but we'll see. All right. Most of the factors you can see here, this is the price of gold. It's leading on the way down. This is saying we're going to have lower 10-year treasuries. The red line in there, that's the CRB, lower 10-year treasuries. The blue line hooked up, and that's 10-year treasuries in Germany, the biggest competitor to U.S. bonds, and so bond yields did go up. This is all in yield terms. Dollar. Who told you at the beginning of the year that the dollar was going to be strong? Of course I did. That's why you're watching even the freebie version. Dollar's going to remain strong. It's going to remain strong, particularly against the feeble Japanese yen. Gold broke the giant triangle formation that we have been talking about. This is a descending triangle. Normally it's not a topping pattern, but you can see we broke all of these lows. There's a third low over here, so 1, 2, 3 lows. It broke the low that we made a week or so ago, and there you go. See you later, gold. Why? Because real interest rates are high, and because the Indian wedding season is not going to be that great. Why? Because the Indian rupee is weak. Why? Because of high inflation. There you go. Now you know how to analyze gold. The indicators, we've got two bearish. The top two, this is the euro, this is the CRB. The bottom one pretty flat, so let's call that one neutral. But nonetheless, it's bearish gold. Crude oil. That's it for commodities. I mean, commodities are all going to go into bear markets now. We had gigantic bull run, which of course I told you about at the beginning of the year, and you made, if you follow what we do here, you made a lot of money on commodities on the long side. Now it's time to go to the short side. We're going to see bigger planting of grains, legumes, so we're going to have bigger crops next year. We're going to see more, we're seeing slowly but surely more drilling for oil. We're going to have copper production at all-time highs. So all the commodities, the supply is going to be increasing, not a huge amount, but demand will be plunging as we go into recession. So commodity prices, big bear, big bear. Now that's good for inflation, but good for inflation next year after we see the big recession. Bitcoin can't get out of its own way. We had the plungerama over here from 30,000 down to 20,000. It seems to want to hold the 20,000. I think a lot of people are coming in and buying. This was a bit of capitulation over here in June, but we're making higher highs and higher lows, but then the purple predictor craps out. So I can't get excited about being either long or short, but as I told you, I'd probably rather be on the bear side as the Bitcoin bubble bursts. And I think we're going to probably head down to 10,000, but I don't have a position in Bitcoin right now. All right, freebies, love having you here. There are dramatic calls. That's why you watch Wall Street Winners, because you want the big moves, make the big money. And I'm the guy that's telling you the big moves, and I'm twisting and turning all the time to get you those big moves. Hey everybody, Courtney Smith here, and I just wanted to kind of reveal with you one of my secrets of my success, and that is I use a website called stockbutler.com. And the reason I use it is because it saves me so much incredible time, and it was based on my forms of analysis. The Stock Butler was developed by one of my brilliant students. Of course, all my students are brilliant, you know that. And he designed it around my technique for fundamentally selecting stocks. So all you have to do is you come here, you go to rate, you go to best of the best, that's the name of the technique, and bingo, there's the list. And then, since there's only 4 stocks there, no problem. Go up to rate, go down here to advanced stock list. I usually change this to main E table, update the list. Anything in green, I'm interested in. Now, I know that these are fundamentally powerful stocks. Now, all I have to do is go find the correct technical entry and exit point. So, Stock Butler saves me a tremendous amount of time, keeps me focused on only the best of the best stocks instead of wasting my time on other garbage. All right, everybody. We'll see you later.